Good afternoon, and welcome to the AFS Best Practices Leadership Webinar. Thank you for joining us today. Our topic is Pricing Fundamentals, a review of 2Q 2021 commercial lending landscape. This webinar will be approximately an hour long, and our speakers today are Don Doherty, Jeremy Charlson, and Rob Lynch, all from the AFS Business Intelligence team. Before we get started, there are just a few reminders for today's event. We do encourage questions. Please use the Q&A feature to ask your question, and we'll leave some time at the end of our prepared remarks to answer as many questions as possible. We are recording today's session, so tomorrow you will receive an email with a link to listen or download the presentation. Thank you for joining us today. Don?
Thank you, Renee. Hello, everyone, and welcome to our webinar, Pricing Fundamentals, a review of the 2Q21 commercial lending landscape. We here at AFS know how busy all of you are, and we really appreciate you taking the time to join us today. As we get started, I want to say that we certainly welcome any comments any of you may have on today's webinar. Our contact information is provided at the end of this presentation, so please do not hesitate to reach out to us. It is worth noting that the source of the data presented today is from the AFS Pricing Service. This database is the industry source of pricing trends for commercial lending and contains over $1 trillion in commitments, with approximately 80,000 new and renewed loans being added to our database each quarter. This database is also used to prepare our Pricing Trends monthly newsletter. Again, please reach out to us if you are interested in learning more about our pricing service or if you are interested in receiving our monthly newsletter. As we move to slide 4, today we will be reviewing results through the second quarter 2021 with a focus on loan growth, pricing and fees, and risk and return. A quick housekeeping note: unless explicitly noted, all charts in this presentation exclude the Paycheck Protection Program loans. To get started, we move to slide 6, where we look at a couple of the macro drivers of commercial loan growth. Last quarter, we posed the question, is an economic boom imminent? At that time, the economy was expanding rapidly due to the lifting of COVID-19 restrictions and the rollout of the vaccine. GDP data released last week revealed that the economy grew 6.5% in the second quarter, maintaining the high rate of expansion seen earlier this year. However, while more establishments continued to reopen in the second quarter, most notably in the services industry, we are beginning to see several frictions in the economic recovery. In particular, labor shortages and supply chain bottlenecks in certain sectors have resulted in a surge in prices and the highest inflation readings in years. Specifically, the Consumer Price Index jumped 5.3% in June when compared to June 2020. The core CPI, which excludes food and energy prices, increased 4.5% over the same period, the largest rise since November 1991. The Federal Reserve believes that these price pressures are temporary and the factors driving it will ease when unemployment benefits expire in September. Still, higher inflation could temper the economic recovery. The inflation trend, along with stalling vaccination rates and new strains of the virus, complicate the economic outlook and, by extension, the outlook for commercial loan growth. Next, on slide 7, we examine recent commercial loan growth trends. Here we show annualized month-over-month growth rates for C&I loans, shown in blue, and commercial real estate loans in orange. Note that this chart includes loans made as part of the Paycheck Protection Program. In the second quarter bank earnings releases, several banks described commercial loan growth as challenging. While banks appear willing to lend, middle market customers are still cautious. At the top of the house, it's difficult to discern the true level of loan demand in the market given the recent and expected declines in Paycheck Protection Program balances. On the chart on the left, you can see C&I loan balances, including PPP loans, were down 3.2% month over month in June and down 15.1% year over year, as shown on the chart on the right. Later on, we'll examine these trends without PPP loans, which will show that growth in conventional C&I lending was positive in 2Q, albeit not very robust or broad-based. The chart on the left shows CRE loan balances were up 0.5% month over month in June, the highest rate seen this year. Banks in our pricing services have shared that multi-lending is back in a big way, and industrial warehouse lending is also strong. However, the arrival of the new Delta variant of the coronavirus, coupled with the transition to a permanent work from home model for some employees, certainly complicates the outlook for CRE lending, especially for the lodging and office property types. As we move to slide 8, we examine the loan balances this quarter relative to where they stood before the pandemic. This chart compares balances in each month to a December 2019 baseline, which is indexed at 100. So a value above 100 indicates that balances in the month were X% higher than they were in December 2019, while value below 100 means that balances are X% lower. The dip we see in June for the blue series, inclusive of PPP, illustrates the sharp and expected declines in PPP balances mentioned earlier. The orange series, the loan growth trend without PPP loans, has a value of 99.3 in June, or 0.7% lower than where they stood in December 2019. This is a slightly improved figure from May, but as of June, non-PPP loan balances have not yet recovered from the deep contraction the market experienced last year. It will be interesting to see how this trend plays out over the second half of the year and whether some of the new headwinds for loan growth intensify or weaken. Next, on slide 9, we examine recent balance growth trends by deal size. One of the key trends we observed prior to the pandemic was the bifurcation in commercial loan growth by deal size, meaning that most of the growth was driven by larger deals while balances were contracting in the smaller end of the market. Looking at the more recent trend, the good news is that balance growth in 2Q21 was positive, with non-PPP loan balances up 0.4% from March to June, as shown on the chart on the left. The largest deals, those greater than or equal to $25 million in commitment size, certainly contributed to this increase, up 0.9%. Balances for this segment increased in 1Q and again in 2Q. We also saw a rise in balances in the $1 to $5 million deal size range in the second quarter, up 0.8%. When we go back further in time, we see an interesting trend emerge, as illustrated by the chart on the right. As we pointed out earlier, the overall commercial loan market has yet to recover from the deep retrenchment seen in 2020. There is, however, one segment that has recovered its lost ground, the greater than or equal to $25 million deal size range. Balances in this segment were up 3.5% in June when compared to December 19. No doubt the smaller end of the market benefited from PPP and other forms of government assistance, so it makes sense that lending to this segment has been slower to rebound. Nevertheless, the trend depicted here suggests that banks are still somewhat cautious about credit quality and prefer the larger, often better rated deals when it comes to new lending. Moving to slide 10, we can continue to observe a wide range of results in loan growth when segmented by geographic location. On this slide, we pinpoint the top 5 and bottom 5 states for commercial loan growth quarter over quarter, with the ranking for bilateral loans on the left and participations on the right. For bilateral loans, Minnesota led the growth this past quarter, with a large increase seen in the finance and insurance industry, more specifically in the subsectors for insurance carriers and credit intermediation and related activities. Also contributing to Minnesota's growth this quarter were 2 subsectors within wholesale trade: merchant wholesalers for grocery and related products and for farm product raw materials. The increase for the second-ranked state, Texas, was heavily concentrated in the computer and electronic product manufacturing subsector. Moving over to participations, Massachusetts reported a large increase in the funds, trust, and other financial vehicle subsector within the finance and insurance industry, which contributed to the 8.3% increase. Moving on to slide 11, we shift our focus to year-to-date commercial loan growth. For bilateral loans shown on the left, we see Texas ranked number 1. Higher balances were seen in the manufacturing sector, again, heavily concentrated in computer and electronic product manufacturing subsector, and in the utility sector, more specifically in the electric power generation, transmission, and distribution subsector. This growth helped to offset a large drop in mining, oil, and gas loan balances in Texas. On the right chart, Tennessee's year-to-date increase of 15.6% in participations was attributed to growth seen in gasoline stations, hospitals, nursing and residential care facilities, and the primary metal manufacturing subsectors. These higher balances outweighed the poor performance in Tennessee's accommodation and food services subsectors centered on traveler accommodation and restaurants and other eating places. Moving to slide 12, we look at GDP and loan growth. In terms of the drivers of commercial loan growth, GDP is one of the leading indicators to watch. One development over the last several years has been the concentration of economic activity in the largest metros of the country. This has resulted in a bifurcation in loan growth trends in which lending has become increasingly concentrated in the economic hubs of the country. On this chart, we aggregated the top 10 core-based statistical areas, or CBSAs, in terms of real GDP and examined loan growth for this group versus all other geographic areas. While loan growth slowed across the country in 2020, the downtrend was much more pronounced for the areas outside of the top 10 CBSAs. As of June, total balances for all other geographic areas were lower than the pre-pandemic level, down 3.4%. Conversely, the pace of balance growth accelerated in June for the top 10 CBSAs, with balances for this group 3.1% higher than the pre-pandemic level. It will be interesting to see how these trends evolve in the coming months. COVID-19 accelerated many demographic and economic shifts that were already underway, including movement out of the country's most expensive cities. Perhaps commercial loan growth will pick up outside of the top 10 CBSAs if people continue to migrate out of urban centers and into more suburban, rural areas. In addition to geographic location, industry sector is one of the key drivers of commercial loan growth. On slide 13, we examine the industry rankings for balance growth. Manufacturing of machinery and electronic products led quarter-over-quarter bilateral loan balance growth, where significant growth was seen in Austin and Beaumont, Texas. Next, you can see that finance and insurance and wholesale trade are in the top 5 for both bilateral loans and participations. For the finance and insurance sector, Miami had higher quarter-over-quarter loan balances for both bilateral loans and participations. Bilateral balances were also higher in this sector in Los Angeles, Chicago, and Dallas, while New York, Boston, and Atlanta also recorded higher participation balances. In the wholesale trade sector, bilateral balances rose in Philadelphia, Dothan, Alabama, and Minneapolis. Participation balances increased in Chicago, Toledo, Miami, and Portland, Maine. Moving to slide 14, we again focus on year-to-date commercial loan growth. And again, we see that wholesale trade and finance and insurance are in the top 5 for both bilateral loans and participations. Year-to-date bilateral balances in the wholesale trade sector were up significantly in Miami and Philadelphia as participation balances increased in Chicago and Dallas. In the finance and insurance sector, year-to-date bilateral balances increased in Los Angeles and Minneapolis, while year-to-date participation balances were up in New York and Miami. On the next slide, we look at line utilization, which can certainly have an impact on loan balances. During the recent weeks, several banks have reached out to us asking if we could provide any insight on C&I line of credit utilization. Most banks said that utilization is low relative to pre-pandemic levels. On this slide, we trend the line utilization rates for bilateral loans in blue and participations and syndications in orange. Consistent with the feedback we received from the banks, line utilization for both segments has yet to return to pre-pandemic levels. You can see those trends on the chart on the left. In fact, for participations, line utilization in June sunk to the lowest level seen in several years. The good news is that we are seeing line utilization trend upwards, albeit slightly for bilateral loans. That increase is more explicit on the chart on the right, where we focus on the most recent 6 months. Over this period, line of credit utilization increased 83 basis points, rising to a rate of 32.2% in June. That is the highest utilization level recorded for bilateral loans in 2021. Hopefully, as the economy continues to improve, we will see even higher levels of business confidence in the form of increased line of credit utilization. Our next slide presents the drivers of line of credit utilization rates for bilateral loans. The industry subsectors shown here displayed the largest increases in utilization levels over the last 6 months. The most pronounced change was observed for the computer and electronic product manufacturing sector, pictured here second from the left, in which utilization spiked in May and increased again in June. In contrast to the broad market trend, June's utilization rate was above the pre-pandemic average, which is depicted by the dashed red line. Interestingly, 6 of these top 10 subsectors plotted here are in the broader manufacturing category. Another noteworthy sector is hospitals, pictured fourth from the right. Line utilization has trended upwards recently for this industry. However, the June level was well beneath the sector's pre-pandemic average, and line utilization for the hospital subsector trends well below the levels of the other industries. While utilization for this hospital subsector was low even before the pandemic, the readings in 2021 are especially low. It is not immediately apparent why this is the case. One theory is, perhaps now that elective surgeries are permitted once again, the top line revenue at hospitals is robust and the need for credit is lower. Our next slide presents a trend of line utilization by risk rating. When first analyzing the second quarter results, our initial assumption was that the riskier borrowers were driving the increase, since we heard anecdotally that many of the better rated borrowers are still sitting on the sidelines when it comes to borrowing. We found that was not the case this past quarter. Historically, line utilization positively correlates with risk rating, meaning that riskier borrowers utilize more of their available lines versus the better rated borrowers. For the most part, that pattern held true in the second quarter. What's more interesting, though, is that the recent increase in line utilization was driven by the best rated borrowers, those risk rated 1 and 2 on our standardized 10-point obligor risk rating scale. The yellow line on this chart provides that trend. Line utilization for these borrowers increased from 24.4% at the end of 1Q21 to 30.1% in June. Line utilization continues to be a top-of-mind topic with our clients, so we will continue to monitor this trend closely during the second half of the year. Next, on slide 18, we look at another driver that can affect loan balances, that is new and renewed loan volume. As illustrated by the chart on the left, volume for both new and renewed deals increased in June. Knowing the impact the pandemic had on businesses last June and its effect on commercial lending, it's good to see that new volume in June was well above the level seen in June 2020, up 50%. Renewal volume was also higher when compared to June 2020, up 19%. For all of 2Q21, new volume was 10% above the level seen in 2Q20. The chart on the right shows this comparison. On the other hand, renewal volume in the quarter was down 9% from the level seen last year. On slide 19, we analyze where new and renewed lending is growing. The chart here is an industry distribution of new, renewed, C&I bilateral activity. The industries shown here are those with the largest new and renewed quarterly volume. Our goal here was to see if volume in the second quarter was materially different from 2Q20. New and renewed volume increased for 3 finance and insurance related subsectors shown within the circle on the far left of the chart. This jump in new and renewed volume contributed to the overall balance growth we saw earlier for this sector. Several banks reported a modest increase in new and renewed volume for the publishing industry subsector comprising software publishers, which is also highlighted in the middle of this chart. And we saw lower new and renewed volume in 2Q21 in the utility subsector focused on electric power generation, transmission, and distribution, again highlighted in the middle of this chart. And finally, the ambulatory healthcare subsector, shown on the far right, had a decrease in new renewed volume this quarter. However, this decrease can be attributed to higher 2Q20 volume due to COVID-19 activity. Okay, that covers our review of loan growth for 2Q21. Next, we will examine how loan pricing has varied through the second quarter. With that said, I'll turn it over to Rob Lynch for an analysis of 2Q21's commercial loan pricing and fees. Rob?
Thank you, Don. Good afternoon, everyone. In looking at pricing for new and renewed loans, we see very little movement in the second quarter. The chart on the left shows interest rates for new and renewed bilateral loans, excluding PPP. And since May 2020, rates have been in a very narrow range and trending slightly lower. The chart on the right shows a similar picture for participation, where there were more modest movements over the same time period. In June 2021, interest rates for new participations were stable, and interest rates on renewals were decreased. While interest rates on loans are not moving all that much, it is important to note that the rate on the 10-year Treasury decreased over the last quarter. Not shown on this chart is the further decrease reported in July and early August. At the end of July, the rate decreased another 20 basis points from the levels you see on this chart, and as of yesterday, it was about 1.2%. It will be interesting to see whether this will have any impact on loan interest rates in the coming months. The next slide shows a breakout of loans by type over the last 18 months. With the sunset of LIBOR getting close, we wanted to see what other indexes are being used. And as this chart shows, the percentage of new and renewed balances booked in LIBOR unexpectedly increased from the prior quarter. Fixed and prime indexes were the primary alternative, but while still small, close to 2% of balances were booked to SOFR and other floating rates. We will continue to watch this over the coming months as we get closer to the end of LIBOR. On the next slide, we take a look at some of the specific industries where the use of LIBOR was more prevalent. The top chart shows the index composition from the first quarter 2021, and the bottom chart shows the same industry segments for the second quarter 2021. While the accommodation sector showed an increase in LIBOR balances, there was also an increase in prime and SOFR, while the use of fixed rates declined substantially. Nursing care showed the largest reduction in LIBOR balances and a sizable increase in SOFR balances. Oil and gas extraction showed a higher use of LIBOR quarter over quarter. This subsector has historically used LIBOR, and it will be interesting to see how this might change over the coming months with LIBOR coming to an end. On the next slide, we look at interest rates by type and by industry for the second quarter. On this chart, each bar represents the interest rate or unique index used in the industry. Accommodation, entertainment, and food had the highest rates across the different indexes, with the exception of prime, which was slightly lower than the prime for mining and transportation. Retail and wholesale trade and manufacturing saw the widest differences between prime and the other rates. Fixed rates were generally the second highest interest rate after prime across all these industries. Turning to fees, this next slide shows that fee incidence in the left-hand chart decreased for both new and renewed loans over the quarter. Compared to last June, fee incidence for new loans is sharply lower, while fee incidence on renewals was steady. Fee level in the right-hand chart increased for new loans in June, while renewals saw a decrease. Fee levels on new loans were above those seen a year ago, while renewals were slightly below those from last year. On the next slide, we look at fees by industry. Fee incidence in the chart on the left was lower for all industries. When looking at fee level in the right-hand chart, healthcare saw the largest decline, followed by mining and transportation, while accommodation, entertainment, and food increased over the quarter. Accommodation, entertainment, and food, as you might recall from 2 slides ago, also had the highest overall interest rate of these industries. This could be viewed as an indicator of potential weakness within this sector. That concludes the remarks on the pricing and fees section, and I'll turn it over to Jeremy Charleston, who will cover risk and return. Jeremy?
Great, thanks a lot, Rob. So I think for this last section, we want to consider some of the pricing trends that Rob presented in the context of credit risk. And one of the big themes that we're seeing in 2Q is that growth, while it has been positive, loan growth that is, it really wasn't all that robust. And often what happens when loan growth is not robust is we see a trend in declining spreads, perhaps higher risk appetite in terms of looking for new loan opportunities. And we wanted to see if that's playing out in the commercial space in the second quarter. So to start, I wanted to take a look at, and bear with me one moment, the PowerPoint froze, there we go. So just as a way to measure risk appetite, I wanted to look at trends in bond yields over the last several months. What we're doing here is for the corporate bond market, we're looking at trends in bond yields by risk grades. Now, I'll qualify this by saying, I know the bond market is not directly comparable to the loan market, but the trends that we see in bond yields, they are a reliable gauge of risk appetite in financial markets, and they do have meaningful implications for commercial loan pricing as well. Now, if you look at the left-hand chart, what we're seeing is that bond yields are declining across nearly every risk bracket for triple B, double B, and so on. I think what's actually more interesting, though, is that if you look at the distance between the lines, between the colored lines, those are measures of credit spreads or risk premiums. So it's the extra yield that you're charging for moving up to a worse end risk grade. The distance between the lines has actually shrunk over time. And you can see that actually a little bit more explicitly on the right-hand chart. We plot the credit spreads for different comparisons of risk brackets. And what we're seeing is that the credit spreads have narrowed broadly year over year. And in some cases, credit spreads are actually lower or more narrow than they were prior to the pandemic. So all this points to a higher degree of risk appetite and risk tolerance in financial markets. And I think our question here, our purpose for this presentation, is to see whether or not we're observing a similar trend unfold in commercial loans. Are banks becoming perhaps a little bit more aggressive in the lending terms and the credit standards in order to win new business? And actually, we can see a measure of that here for commercial loans on this particular chart. This is actually sourced from the Fed's Senior Loan Officer Opinion Survey, which is a really neat survey that comes out that measures supply and demand for large and medium C&I loans. This chart can be a little bit tricky to read because of the way the axes are set up. But basically, that blue line there, that measures the net percentage of banks that tighten standards on C&I loans. So when that blue line is above the x-axis, it means that banks are tightening standards. Whereas if that blue line is below the x-axis, it means that banks are actually easing standards. And then we have an orange series which plots the demand for C&I loans. And if that series is above the x-axis, it means demand's getting stronger. Whereas if it's below the horizontal axes, it means that demand is getting weaker. Now, what we saw coming out of the pandemic is that banks significantly tightened standards on C&I loans. At its peak last summer in 3Q20, about 71% of banks surveyed reported that they significantly tightened standards for C&I loans. Again, not surprising. A year ago, things were still very, very uncertain. GDP had contracted. I think it was the worst that we've almost ever seen. So not surprising that banks had a much more pessimistic view about credit. That trend, though, has reversed in the more recent years. So you can see in 2Q21 and again in 3Q21, which represents the July survey, in both quarters or both time periods, banks actually reported that they significantly eased standards on C&I loans. So again, going back to what Don showed, where loan growth really has been pretty sluggish. Often when that happens and when the economy is improving, the response of banks is to ease standards on commercial loans in order to potentially attract new business. Banks in the survey did cite a lot more competition. For example, they were saying that with low rates, a lot of customers are refinancing their loans, sometimes with non-banks as well. And so there's a lot of competition, pricing competition to win new business. One of the more favorable findings from the survey is actually that orange series, where for the first time in several quarters, demand for C&I loans did increase. It was not a huge improvement, but at least trending in the right direction. But I think what we're going to try to figure out over the next few slides is, given these dynamics, given the fact that banks seem willing to go out further on the risk curve, what does that mean in terms of spreads? Are banks willing to narrow spreads to win business? What are we seeing that, or how are we seeing that play out in terms of pricing and risk return trends? Now, when we are looking at some of these charts, it almost feels kind of strange to be having discussions about risk appetite when just a year ago, the expectation was that loan defaults were going to significantly rise. What we're looking at here is for both C&I and commercial real estate loans, a trend in weighted average probabilities of default. And specifically, we're excluding the non-accruals. We wanted a more forward-looking estimate of probability of default. So we're just focused on the accruing loans in the database. The good news is that for both C&I and CRE loans, default projections improved in the second quarter. For C&I loans, which is the blue series on this chart, the weighted average PD improved 23 basis points quarter over quarter. And in fact, the weighted average PD in June really wasn't too far off from where it stood prior to the pandemic. It was only about 9 basis points higher. So really over the last few months, seeing a very, very significant improvement in the default outlook for C&I loans. Not seeing quite the same trend for commercial real estate. Again, the CRE line here in orange, the weighted average PD did improve quarter over quarter, but compared to the pre-pandemic average, default expectations are way higher than they were in December of 2019. Most of the reason why the PD estimates are still elevated for CRE loans is because of the lodging property type, so hotels and motels. That segment has been very, very slow to recover, even as more people are beginning to travel now. Non-accruals and delinquencies in that space are still very high, and the weighted average PD in that segment is also very, very high. So that's really what's keeping that orange series elevated. But the bigger takeaway for me, again, is that blue series, the C&I line, where we're really starting to see credit normalize for C&I loans. And when default expectations normalize, often there comes more of a willingness to go further out on the risk curve and or compete on spread for C&I loans. Just to give you a little color into what's driving the improvements that we're seeing in credit risk for C&I loans, we have two charts here that illustrate on the left the industry subsectors with the biggest improvements in weighted average PD, and then on the right, the industries with the largest deteriorations. Now, I will say that if you were to look at all 100 three-digit NAICS sectors, by far the majority had an improvement quarter over quarter. So the market as a whole was really trending in the right direction. At a subsector level, the biggest improvements that we're seeing are for oil and gas related industries. You can see that on the left-hand chart where the weighted average PD for oil and gas extraction and then support activities for mining both really improved quarter over quarter. Now, the oil and gas PD is still really high. It's still north of 4%, but that improvement is certainly notable and is certainly a big driver of why the market average PD has been trending in the right direction. I think when I last checked, the WTI price of oil was north of $70 a barrel. So certainly that's going to correlate with an improved credit outlook for the oil and gas sector. Similar story for clothing stores, which on the left-hand chart, that's pictured third from the right. You can see that also had a pretty big improvement, I guess, now that more customers are shopping and now that more of these establishments have opened their doors again. Now, while the deteriorations in default outlooks were less prevalent, we are seeing some big hitters. The most notable one there on the far right is for water transportation. That mainly encompasses cruise lines. That's been a sector that really got hit hard during the pandemic, and it's continuing to deteriorate in terms of its default outlook. In fact, it had a weighted average PD north of 14% as of June, which is one of the worst that we're seeing across any industry subsectors. So I wanted to keep your eye on if you have material exposure to that particular industry. So with an overall improved default outlook for C&I loans, we wanted to see how banks are pricing for credit risk. The charts here admittedly are a little bit busy, but there's a lot of good information to glean from them. So what we're doing here, we're plotting C&I loans on the left and then the picture for commercial real estate on the right. The risk grades are going across the x-axis, and what we do is we align the obligor risk rating scales of all the banks to a standardized 10-point scale that has 6 pass gradations, and then 7 through 10, which aren't plotted here, would be the criticized categories. The lines that you see on these charts, those plot weighted average LIBOR equivalent spreads by a risk grade. And it might seem a little strange to be looking at weighted average LIBOR equivalent spreads given the approaching cessation date for LIBOR, but as Rob pointed out, that is still the predominant index for new lending, and we really haven't seen a clear alternative emerged just yet. Then the bars behind the lines, they plot the distribution of new renewed volume for each risk grade. So they can show you whether or not we're seeing any signs of risk migration year over year. I think the most significant finding on these charts is that if you look at the line series, spreads narrowed year over year across every risk grading category. In fact, that was true for both C&I loans as well as the commercial real estate activity. The most pronounced erosion that we're seeing is for the better rated C&I loans. So on the left-hand chart, for C&I loans risk rated 3 and 4, that's where the changes year over year were the most negative. Now, in terms of the volume distributions, we are seeing some risk migration take place. The distribution for C&I loans, it shifted slightly to the right, meaning that we're seeing less volume in ratings 3 and more in ratings 04 and 05. So in 2Q of this year, banks went out a little bit further on the risk curve for C&I loans than they did a year ago. And again, that speaks to the fact that perhaps with pricing competition being more intense, banks are willing to ease lending and credit standards a little bit for their C&I activity. It's the opposite trend for commercial real estate. Volume decreased in ratings 5 and 6 and increased in ratings 2, 3, and 4. That means that compared to a year ago, banks this quarter were a little bit more conservative in terms of the CRE borrowers that they lent to. So in the bond yield charts that we shared earlier, we saw that yields were falling across the risk spectrum, and the differences between the risk grades, the credit spreads, they were also narrowing over time. For C&I loans, we're also seeing pricing fall across risk grades. Here on the left, we plot the LIBOR equivalent spread trends for investment grade loans in blue versus the non-investment grade loans in orange. And spreads for both risk categories narrowed year over year. Again, this is possibly a response to sluggish loan demand, in which banks are offering more competitive spreads to attract volume. On a year over year basis, the decline for investment grade loans was more pronounced than the decline for non-investment grade loans. So the credit spread in the C&I space actually increased, which is a little bit different than what we're seeing in the bond markets and the broader debt markets. But the takeaway, though, is that banks appear more willing to ease spread for the better rated customers. And I think that's where most of the pricing competition we're going to see this year is going to be concentrated in the investment grade space. We see this reflected on the right-hand chart, which plots the dispersion in spreads by bank and by risk grade. These box and whisker charts, they can be a little bit tough to read at first, but basically what we're doing is we're looking across all the banks in our service and we're plotting the dispersion in spread pricing. So the tails capture the min and the max bank in terms of LIBOR equivalent spread, and the market average is the dot in the middle of those tails. And what we saw year over year is that nearly every bank in the service decreased spread for the investment grade loans that they booked. You can see, for example, the dispersion profile for investment grade loans that shifted somewhat downward from 2Q20 to 2Q21. Now, the trend was not quite as uniform for the non-investment grade loans. In fact, several banks significantly increased spread or tightened standards for their non-investment grade loans. That's why the tails on both ends widened for the two box and whisker charts on the right for the non-investment grade loans. And in a lot of ways, this is similar to the trend that we saw coming out of the previous recession, in which pricing competition really heated up for the best rated credits, but was a bit slower to intensify in the lower end of the market. Now, a key driver of a bank's risk return profile is its industry composition. There are some industries that, for whatever reason, seem to outperform C&I averages for both risk and return. So looking at the scatter plot here, you can see just how much risk return varies across the industry spectrum. What we're doing here, every dot is a 3-digit NAICS subsector, and for each industry, we're plotting its weighted average risk rating on the x-axis versus its weighted average LIBOR equivalent spread on the y-axis. And then the black lines, the horizontal and vertical black lines on this chart, those represent the C&I averages in 2Q21. Generally speaking, there is a positive and rational relationship between risk and spread. Believe it or not, we don't always see that when we drill into particular CBSAs or into an individual bank's profile, but at a market average level, typically industries with higher risk also have higher spreads. What we wanted to do on this chart is highlight some of the positive outliers. So what we did is for each sector, we divided the spread by the weighted average risk rating to come up with what you might call a some type of risk-adjusted spread. So the green dots here are the sectors with the highest returns relative to risk. What's really interesting here is that many of the industries in green are sectors that faced pretty significant challenges last year during the pandemic. Industries such as movie theaters, oil and gas, and transportation. However, the spreads for these sectors are so high relative to most other industries that they compensate for the higher level of credit risk within them. So if you're willing to take a bet on credit risk, many of the sectors highlighted green here do offer very, very attractive spread pricing. I will note that there are a couple of sectors, green sectors, that have both favorable pricing and credit risk levels. So they're not just high risk, high return, they're actually performing well relative to both dimensions. Those two in particular are funds and trusts, or NAICS 525 funds and trusts, and NAICS 524 insurance carriers, which you can see in the upper left quadrant. These sectors have weighted average risk ratings at or better than the C&I average, and they also have spreads higher than the C&I average, so they're very favorable from a risk return perspective. What I thought was notable about them was that they're both subsectors within the broader finance and insurance industry, which Don had pointed out earlier in the presentation. Finance and insurance has been a major industry driver of new lending this past quarter, and perhaps that's because their risk return characteristics are very, very favorable. So just like the first quarter, 2Q was in many ways a favorable quarter. We are seeing the economy continue to rebound. There are some mixed signals, though, that are complicating the outlook. In particular, we are a little bit concerned about inflation and what that might mean for commercial lending in the second half of the year, but it's really too soon to tell what its impact will be. The good news is that if you exclude paycheck protection loans, which are expected to decline, total commercial loan balances, they did increase in 2Q for the first time in a long time. It was a modest increase, nothing to really write home about, but any increase at this point is a favorable finding. And perhaps most encouragingly, what we're seeing is that line utilization is beginning to edge higher in the second quarter. And in fact, there are some industries where it's already returned to the pre-pandemic level. LIBOR, in terms of pricing, that is still the predominant index for new renewed commercial loans. Encouragingly, we are seeing some migration to other alternatives. As Rob pointed out, there are some industries where SOFR lending in particular is beginning to increase, which is a great thing. So we'll continue to monitor that as that trend unfolds. And then in terms of risk and return, we are seeing in some ways a return to the competition that existed before the pandemic. In particular, spreads narrowed year over year across nearly every risk bracket, although the erosion was more pronounced for better rated C&I loans. So I would not be surprised if competition continues to heat up for loan volume. And as always, we'll be sure to highlight how that's playing out across various footprints and industry segments. So before taking your questions, I just did want to point out two other webinars we have coming up that I think you'll find very interesting. One is on ESG and its impact on commercial lending. That's coming up in a couple of weeks now. We know a lot of banks on the line have been asking us about, well, how are green loans growing? What do they look like? What are their risk return characteristics? And we're going to do a very deep dive into how this market has evolved in terms of commercial lending and whether or not these loans have a favorable risk return profile. So if that's a topic that's of interest to your bank, or if you're looking to perhaps expand green lending or sustainability linked loans, certainly encourage you to dial into that. And then we will be also offering a webinar later in the month from our credit risk navigator that we partner on with the Risk Management Association to look at credit trends in particular, and whether or not some of these headwinds that we've been seeing in the economy recently are having any material impact on the economy. So as always, we welcome your questions. I know we still have about 10 minutes on the webinar. So Renee, I think I'll pause there and see if we have any questions that came through from the audience.
Thanks, Jeremy. And again, thanks to you, Don and Rob, for your very thorough remarks for the webinar here. And it looks like we don't have any questions at this time. So we'll give it just another second or two and see if anything comes through. But as just a reminder to everybody that is on the line, we will be sending you a link tomorrow so that you can listen or download the presentation. And please be sure for any of your colleagues that were unable to join us today, if you would share that information with them. I think they'll find the content here very informative. So with that, Jeremy, Don, and Rob, it doesn't look like we have any questions. So we'll go ahead and thank everybody and have a good rest of your day.
Okay, and Renee, I'll just say if anyone does have any questions that come up, our contact information is on this slide, and you should have received a copy of the deck as well. So, we love speaking with you about pricing trends and loan growth opportunities. So by all means, feel free to reach out to us if you have any questions.
Great.
Thank you all.
All right, thank you. Have a good